Today, my guest is Bernard Reisz. He's a CPA and CPCU, and today we're going to talk with him about 401k checkbook and how you can take control of your retirement funds and improve your returns. But first, a quick reminder, if you like the show, we would love to hear from you. You can like, share, and subscribe. And also, if you'd like to see how handsome our guests are, please check out our YouTube channel. That's Commercial Real Estate Pro Network. Bernard, welcome back to CREPN Radio.
Darren, great to be here. Great to be back. I love the last show we did, and I'm really excited about this one.
Well, myself as well. And for our guest, in case you didn't get the or listen to the first episode, I want to encourage you to go back. It was last week's episode, number 171. And in that episode, we spoke primarily about IRAs, Roth IRAs, and a self-directed IRA. And Bernard, if you have anything you want to add to that, and then we can kind of go forward from that point with the Checkbook 401k.
Yes, I think it'd be great for everybody to really check out that prior episode, because all the fundamentals of the Checkbook 401k, the concepts are very much the same as they are in the Checkbook IRA, except that the 401k is just a lot more flexible, has a lot more greater tax strategy, but the concepts are the same. Understanding the distinction between Roth funds and traditional funds that applies within a 401k. Understanding prohibited transactions, that concept applies in the 401k. Understanding UBIT applies to 401k. The 401k has some really neat carve-outs for real estate where UBIT may not apply, but all the same concepts are at work. So today what we want to cover is Checkbook 401k as distinguished from the Checkbook IRA, and explain why it's that much more powerful from a financial strategy perspective and a tax strategy perspective, and why it's key to focus on that at this point of the year, because there's a deadline for taking advantage of this. Your plan would have to be in place by December 31st in order to get that $55,000 tax deduction for 2018. Got
it. So let me start with just a quick question, because I think that myself and anybody that's got an employer-sponsored 401k, that's kind of the reference point. An employer-sponsored 401k, you get your, if you're in a traditional, you have your pre-tax deduction, perhaps you have an employer match, and it's basically invested in a range of funds that are available to you from the broker-dealer or the custodian that your employer has entrusted. Is that fair?
Yes, that's what you'd see in the traditional space, traditional 401k. And what we put in place when we put in place a Checkbook 401k derives from the same section of the tax code, except that we give our clients the full capability that's allowed by the tax code. So when you have a plan through an employer other than yourself, there are lots of limitations and restrictions that they're going to put in place beyond the restrictions of the tax code. So we set up the plan with the full flexibility that's available, this way giving people the ability to maximize their tax strategy and invest as they choose, including putting money into real estate, hard money loans, tax liens, cryptocurrency, you name it. You can do it in the plans that we set up.
Okay. And just for clarification, if I have an employer-sponsored plan currently, is that anything that I can roll into a self-directed or a Checkbook 401k? And essentially that is a self-directed 401k, correct?
So the concept of let's break it up to two questions. So the first question you got is an excellent question. Can you roll over funds from your employer 401k plan? That's one question. The other question is there a distinction between self-directed and what we're calling the 401k checkbook? So the first question, can you do the rollover? The answer is depends. In the event that it's a prior employer 401k, you can always do that rollover. If you're currently employed, there are limitations on those rollovers imposed by the tax code. And once again, usually the employer plan is going to be even more restrictive than that. And for the duration of your employment until you're age 59, they may lock that up. There may be some distinctions. Sometimes people will have an employer plan that's funded with both contributions as well as rollovers that they've done from a prior employer 401k plan. So there may be distinctions between what you can roll over. You may be able to roll over a portion of it, all of it, or none of it. We have a web page where we kind of outline, what the process for doing that is, and we want our clients to be armed with the information that they need, so they can go to their plan administrator at their human resource department and clearly articulate what they're trying to do. Unfortunately, it's just too easy for the HR person to say, no, you can't do that. So you really have to be educated and be able to be a little pushy, perhaps, to make sure you're getting the correct answer. They're incentivized to keep money in the plan with their relationships, whichever financial advisor or broker dealer has that plan. They're making money off the assets that are in there. So there's very little incentive for them to assist you and kind of dig into the nitty gritty to see if you can take that money out.
Gotcha. Okay. So we've established kind of a line, I'm going to say, from an employer-sponsored plan where you are currently employed. Mm-hmm. Let's talk about the other would be you are self-employed. Am I correct? Okay.
That's exactly it. So in terms of distinction between self-directed and checkbook, so every 401k plan or IRA that you have today, you'll be told is self-directed. If you have a 401k plan with an employer, the traditional style 401k plan, they're going to tell you that it's participant directed, because you can go in there and you can choose which funds you'd like to invest in. So they'll call that self-directed. Likewise, even in this space where you're able to have alternative investments, so there are some custodians or administrators that will provide what they call a self-directed plan, but they're going to control your assets. So they're going to hold the money in their account. They may be earning money on your money. They're going to tell you have a real estate deal. Okay, send us the docs. We're going to process it. We're going to send that out. So that, again, that gets to be quite cumbersome. When we say 401k checkbook, we're referring to a 401k in which the plan sponsor, the plan owner, is the trustee and holds the money in a bank account from which they can wire, ACH, write checks. So no transaction fees. There are no intermediaries. You can just do that investment easily, flexibly, and inexpensively. So, and when you've got deals, you've got closings. Time is really important. So that's what we're referring to when we say checkbook.
Got it.
Any questions about that?
Yeah, and I just want to make it clear, if I understand right from our talk last week, that each model is required to have a custodian. Your custodian, can you speak a little bit about the setup of that? I know that you said that you have access to the funds in the checkbook, but maybe you could speak briefly.
Great. So with the IRA, it's hardwired into the tax code that you've got to have a custodian that's, a bank or some institution that's chartered by a state, banking authority. So there's always has to be a custodian when we're talking IRA. So in the checkbook IRA, in order to get people that control, keep the fees down and get the money in the bank account, we partner with custodians. We set up that special purpose business entity within the IRA, and we have the custodian send the money over there. In contrast, a qualified retirement plan, which 401k is one example, does not require financial institution to be involved. So that comes as a surprise to many. It's really unnecessary. You can be the trustee and have the money in a bank account without the involvement of any custodian. So with the 401k side, that's what we give our clients. They're the trustees themselves, the money in a bank account. There's no need to have any custodian involvement, no custodian fees. So ironically, this can turn out to be, it has greater power, greater tax and investing power at a potentially lower cost because there's no custodian required.
Wow, that's fascinating. I did not realize that was the case. I mean, that's empowering when you think about that you can actually take the money and actually be in control of it. I mean, you got to follow the rules and stuff, but still to eliminate the custodian, the fees, and all that. That's great.
And on top of that, I'd say, so we in the checkbook IRA model, we've got the custodian component. Now we've also got the business entity component, and the business entity usually has some fees. We advise our clients in the ways to keep those fees really negligible. But with the 401k, again, you don't have the custodian or the business entity. But some of our clients do want that business entity, that 401k LLC, we call it, inside of the 401k. It's optional. So if you want it, you can add that on, and maybe later in the show, once we've further outlined what the checkbook 401k is, we can discuss what the 401k LLC is.
All right. So let's talk a little bit, and you hinted at it in the beginning about the tax strategy, some of the benefits, the reasons why especially this time of year. It's coming up on Thanksgiving, or we're right around Thanksgiving, so there's about a month left. If you got any ideas on how to structure your 2018. So.
Yes, let's do it. I'm very excited about this. As a CPA, when there's new tax code, we get excited. There's more to research, tax code to read, and we love doing prospective planning, because once the year is over, there's really a finite amount that can be done. Everything is the paint has already dried. But up until year end, a 401k plan can be implemented, and it can be implemented with an effective date of January 1st, 2018. And in general, tax deductions right now are a lot more valuable. Tax deductions are always valuable, but this year they're even more valuable than ever. And that's for two reasons, especially for the clients that are ideal matches for checkbook 401ks. These are really important right now. And the reason for that is the best clients, those people that qualify for the checkbook 401k, in order to qualify for that, you've got to have some sort of self-employment income. So that's some sort of business income. If all somebody has is W-2 from an employer that they're not an owner of, they're not going to be able to have the checkbook 401k, because a 401k has to be sponsored by a business. Now, a business doesn't have to be a huge enterprise. It doesn't need an LLC. It doesn't need a C Corp or an S Corp. It can have those, but it's not necessary. From the perspective of the IRS and the tax code, if you're doing a trade or business, if you're making money somehow, generating profit, that's a business. It's as simple as that, independent of how much complexity or how simple it is. If you're generating profit on an ongoing basis, something that you're pursuing and intend to pursue for long term, you've got a business and you can take advantage. You can create a 401k for that business. Now, for anybody that's got business income, there's a new tax deduction. It's known as Section 199 Cap A, otherwise known as the Qualified Business Income Deduction. Other people have heard it perhaps as the 20% Pass-Through Deduction. And what that deduction says is that for any qualified business income, you get an automatic 20% tax deduction. So if you earn $100,000 in your business, you can just knock off $20,000 off the top, and that becomes $80,000 of income. So instead of paying tax on 100, you're paying tax on 80,000. That's it.
Let me just ask you: is that like a simple, or do you start at basically just lowering your basis, where then you can go to your deductions from the 80 as opposed to starting at the 100?
So what happens is there's a lot more complexity to this, but it takes after all your expenses, so your net income from all your qualified businesses, anything that's treated as qualified business income, you just take 20%. Once you've calculated the net, your revenue and expenses, 20% comes off.
20% from the net, that's huge.
Yeah, that's amazing. So that's something that's available to anybody that's a business owner, but there are limitations. So limitations begin to kick in if you're single or married filing separate, once you've got total income of $157,500, you begin to lose that deduction. There's a phase out, and there are all sorts of calculations to see if you qualify. And that 157 number is not based on your business income that would be eligible for the deduction. That's based on total taxable income. So if you've got business income of 100,000, but you sold a property, and now you've got between your W-2 and your property, now you've got income above that 157, you begin to lose that 20% deduction.
Okay.
And married filing joint, that phase out begins at 315.
Gotcha. So if I'm reading ahead here a little bit, is this where the incentive for the solo 401k deduction?
Yes.
Okay.
That's exactly it.
Okay, gotcha.
Now you can see where if somebody's in the phase out range, then they would benefit. Suppose you've got income of, let's talk about single for a second. You've got income of $200,000. So now you've been almost completely phased out of the deduction. But if you turn around and you put $50,000 into a checkbook 401k, you just knock your income down to 150 and you get the full 20% deduction. So not only do you get, say your marginal income tax rate between combined state and federal, right? That's marginal income tax rate. It's good to clarify because people get confused about tax rates. Right, we have a graduated, tax structure. So in your first X amount of dollars, you pay one tax rate, and your top layer of your income, you're paying the highest income tax rate. So when you get a deduction, you're pulling out the highest tax layer. So if you're single and you have $200,000 of income, and you're in a high tax state, you're potentially giving on that $50,000, you may be paying close to $25,000 in taxes. However, so you make a $50,000 contribution to your checkbook 401k, you just save $25,000 in taxes. Now, above and beyond that, you brought your income down to 150, right? So on that 150, you can just knock off another 20%.
Let me ask you on the pass through the 20%. Is that at a personal level, or is that a corporate or your entity level?
So it's available to. It's at the personal level. So if you're it's actually not. So if this is a C corporation, and we probably shouldn't get too far.
No, but just to understand, so we don't. If I've got an entity and I've run all my expenses through it.
Yeah. It's on the personal level. But the entity, it comes through the income in the entity. The entity will tell you this is how much QBI you have.
Gotcha.
Whether or not you qualify. So suppose you got partners in an entity, right? One partner that's phased out, so they can't take the deduction, and another partner that's not phased out, so they will get the deduction. So it'll flow through, the qualified business income will flow through to the personal tax return from the entity, but the deduction will be taken on the personal
level. Okay, gotcha.
And we've got this tax reform, this 20% deduction. We want to avoid the phase out. If somebody's in a specified service business, once they hit that phase out level, they're just out completely. So if you're an accountant, an attorney, a doctor, those are specified service businesses. And once they hit that 315, 157, once they hit that phase out range, they completely lose that deduction. If you're not a specified service business, then you start hitting all sorts of other limitations. So then your QBI gets capped based on a calculation of the amount of wages that you're paying. So if you've got no wages and no capital assets, then you're not going to get the deduction. Otherwise, there's a calculation based on wages and capital assets. So the key takeaway is, ideally, you want to keep your income, especially if you're a solo business, which is the best match for a checkbook 401k. Once you hit that 315 or 157, you're going to lose this deduction. So you want to find other income tax deductions that will bring you back down into that level where you can get that 20% bonus.
Gotcha. And so let's talk about the money now that we figured out the advantages to tax planning right now. So we've isolated that. We've said, okay, guys, you've got however many days until the end of the year where you can still make this election to lower your income.
And there's another thing we should point out. People maybe think they have the same amount of deductions that they had the prior year. Right now, based on state and local tax limitations, people are losing deductions this year. So deductions you may have had in prior year, you no longer have. So you've got to make that up.
I was going to say, I can't remember, was it the state and local tax cap? I think that was the thing that I recognized.
Yes,
personally.
$10,000.
Yeah. So, and that's, so, and if I just not to go deep in the weeds, but I think that if your income, I mean, obviously if you're at the 300,000 level, like we're talking, or even if you're at the 200,000, you're already past that. You've lost the write-off, correct? I mean, or lost the write-off, but you're not going to get the full
20%. That 20% business income deduction can be gone.
Right. But I mean, as far as from taking a look at like a 17 tax versus an 18 tax return, and I think it was 17, I know it was in 16, that you were not capped on the local, state and local tax.
You were not capped. Up until now, you weren't capped. There was AMT, alternative minimum tax, that was roll and itemized deductions. But the new tax reform introduced a cap across the board. State and local income tax deduction capped at 10,000.
Got it. So the benefit for the listeners here is to recognize that there is a loss that you've already experienced, whether or not you know it today, you will know it by April, right? That you've lost some write-off. So if you're listening and you pay attention, here's some ideas and some ways you can take advantage of the new tax laws and reduce your wages or your income, and also fuel your retirement fund or your 401k, correct?
That's exactly it.
Okay. All right. So we've outlined the tax strategy, if you will, just in kind of an overview of the moving parts and the things that changed and what you can do. So let's talk a little bit more about the 401k. So I am a self-employed, or I've got a company. We're recognized that we need to lower the income so we can take advantage of the 20%. So one of the strategies we're going to take advantage of is we're going to fund my 401k, or is it a solo 401k, or
let's get into that.
Yeah, let's get into.
So what happens is you can do this with any 401k, but with the solo 401k, we're able to give you to maximize the value. So the plans that we focus on, while we're able to provide services for larger companies, if you want to have the ability to invest in real estate using the 401k, that's usually best matched to what we call a solo 401k. And a solo 401k is for a business that doesn't have full-time employees that are not business owners or spouses. That's a lot of words.
Yeah. So, in just if I think of what I heard, so this is truly like the solo. I mean, you're it, except for maybe you've got some family, but you've got contract work or any services you're needing outside of the work you're providing would not be a direct employee relationship. Is that?
So if you've got, the key thing is you have full-time W-2. So say you're a real estate agent and insurance agent. And, so those are kind of classic, best fit for this. So you're getting your 1099, you're a business. You may not have or likely don't have, W-2s. You may have some people helping you out. You may be getting support from an agency, but there's nobody there that's on your W-2 payroll. So you've got nobody other than yourself. Involve your spouse. If your spouse helps you out in the business, they can also participate in the plan, and it's still solo. The concept here is that Congress wanted to structure, when they introduced these incentives and all the incredible tax benefits available to qualified retirement plans, Congress wanted to make sure that owners of large businesses didn't squeeze up, take all the benefit for themselves, and not provide any of the benefits to their employees. So Congress put in lots of onerous compliance stuff, all sorts of testing all sorts of things that have to be met, and liabilities for the business owner to ensure that whatever they give themselves, they're going to give to the employees as well. So within the context of the regular 401k plan, business owners don't love those because they have to pay all sorts of fees and administrative fees and give money, matches, and profit sharing to their employees. So they don't really love these to a great extent. They just want to, they set these up. It's a perceived benefit to employees, but for years and years, they were really just a slush fund for financial advisors. High fees, all being passed on to the employees that were paying high admin fees, high investing fees, limited options, because frankly, the employer was not incentivized to structure these in a way that's optimal because their benefits, their upside was limited. In contrast with that, when we set up a solo plan, Congress said, hey, there are no full-time employees involved here. Everybody that's on the plan is an owner of the business or a spouse of the owner. And Congress figured, if you're the owner's spouse, we don't have to protect you because you're the business owner and employee. It's one and the same. There's no conflict here. So all that compliance burden doesn't apply. So we're able to give clients the full flexibility without any of that admin cost. And that's why we focus on solo plans and because if you give your employees the ability to invest in real estate, who's going to pay to administer that? There's no advisor that's able to collect 1% of the real estate because they don't provide real estate. They provide mutual funds. So you have to kind of restrict the options to avoid liability and have a way for the people that provide services to get paid.
Gotcha. So in your checkbook 401k model, is it geared more for the solo?
Yes, so absolutely. It's in almost all scenarios we're going to be dealing with the solo, and it'll be the owner of the business, perhaps their spouse or business partners, but they're not going to have full-time employees other than those folks. A full-time employee is going to be somebody that's age 21 or older that works more than 1,000 hours per year, has been employed for more than a year. Once you hit that, then you're no longer solo. You've got to give that employee the ability to participate in the plan, and then you've got all the complex 401k rules that are potentially applying, and then it becomes less appealing to have all these neat features, all these cool tax and investment strategy that we build into our plan.
Let me ask you on the ownership percentage. I know from an insurance standpoint, run into this occasionally on workers' comp. There's an exemption option. Is there a percentage ownership requirement? I mean, if I've got somebody that I want to retain, but I'm looking at losing a big option on my solo 401k, but if I can bring you in as a 1% owner, does that keep me out of the...
that should do the trick.
That's it.
If you're ready to give away some equity.
Yeah, no, and I don't know that most would be willing to consider that, but I'm just thinking through I know the questions I get are always, well, what about this? What about that? So that would, at least from a standpoint of a I guess eligibility for the solo 401k, if there was a percentage,
yes,
they would retain the
yes.
You'd still retain the eligibility for a solo 401k.
That's right.
Okay, so we've identified who is a ideal candidate for the solo 401k. Let's talk about and we've talked also in the tax planning the 50,000. What is that a magical? The funding caps. Let's talk about the numbers as far as the limitations on how much you can contribute.
So there are a couple of moving parts here. So the max that can be contributed, tax deductible, each year is $55,000. If you're older than age 50, you get another $6,000, so it's $61,000. And that number, increases incrementally in most years. You'll get a bump by $500, $1,000 a year. So it goes up over time. and it goes up at a faster rate than the contribution amounts for IRAs. So IRAs have really been static for so long, whereas 401ks have seen increases just about every year. So that's the total tax deductible amount. And those are limits imposed by tax code and interpreted by the IRS. However, in order to get that full $55,000 tax deduction, there's a bit of a calculation that has to be made in order to optimize it. So the first thing to be aware of is if you're a solo business, business owners only, you've got to have that much income. If your business is running at a loss, you can't do it.
Right. Okay, I gotcha. Yeah.
And no, some people, they want to get money into a plan somehow, or they think they're going to get a tax deduction here and offset their other income. That won't work. The business has to have income to support that. That's the first thing.
All right. Okay, so you got to at least be generating the amount you're, and that's net income, right? I mean, after taxes, okay. So your net income has to at least be that of or more than what you're going to contribute into your solo 401k there. Okay, so.
But there are some more moving parts. We should just briefly outline how that works. So there are. And this is all on the tax deductible side. There's other features. Hopefully we'll have some time to talk about those. Yeah. But when we talk about the tax deductible side, there are two components. There's the employee deferral, and then there's the employer profit sharing. So just like people may have seen at their large employers, they can choose to contribute part of their wage to and get a tax deduction. And then they may have a match of some sort or profit share from the employer side. Those two features exist in a 401k checkbook as well. And it's the interplay between those two that enables you to maximize the deduction. So over here, whereas when you're working for a company and they have a 401k, you get a tax deduction to benefit for deferring part of your wage. The company gets the benefit of the tax deduction for their contribution. Over here in the solo, you're kind of playing both sides. You're on both teams. There's only one team. It's just you, so you benefit from the tax deduction as both the employer side and the employee side.
Okay, what about that profit share mention?
Okay, so the way it would work is, for a self-employed person, you get to the employee deferral. The employee tax deduction is $18,500. So there's a sublimit within the 55. On the employee side, the employee tax deductible contribution amount is capped at $18,500. But what's really neat about that is that it's dollar for dollar. So suppose you had an $18,500 of self-employment income, you can just dump all of that into the 401k plan and eliminate it completely. No income. So that's a dollar for dollar contribution. And that's one of the reasons why the solo 401k is so much more powerful than a SEP IRA, because there's that $18,500 dollar for dollar contribution.
So dollar for dollar, you're saying for net income to contribution. That's the dollar.
That's right. If there's $18,500 income, you can just wipe that out. How do you get up to the 55? So above to get to that number, you need the taxable profit sharing contribution, and that the tax deductible profit sharing contribution, and that is 25% of your net income, so to speak. The calculation is a bit more complex and will vary whether or not you're an S corp or a pass-through entity, but it's 25% of your net income. So if you're earning, $100,000. So if you're you can essentially take 20% of that as a profit sharing deduction. And that's where the second component of the tax deduction comes from. And you can see over there, it's not dollar for dollar. So if you have $55,000 of income, you can't just eliminate all that by contributing to the 401k, because your tax deductible portion from the employer side is going to be 20% of that 55. So in order to get the full 55 tax deduction, you've got to be earning closer to 170,000 or so.
I'm sorry, you faded out there. The number would you
Yeah,
say?
in order to get the full 55 tax deduction, $55,000 tax deduction, your earnings from self-employment have to be about 170,000.
Gotcha.
The employer side is a percentage of the income. It's not dollar for dollar.
Got it. So, but this all would occur within the employment structure, the entity, correct? Or can you do this if you're a sole proprietor? Or?
Yeah, sole proprietor. The numbers flow a little differently if you have an S corporation, but it doesn't. You don't have to have an S corporation, and in fact, some cases it's counterproductive to have an S corporation. But if in an S corporation, the way it would work, the way that 25% gets calculated, it's as a percentage of the salary. So let's just an S corporation. Let's give a little bit of context for listeners that may or may not be familiar with this. When somebody operates as a sole proprietorship or an LLC that's a disregarded entity, so any income that comes into the business just flows right through to the business owner as self-employment income.
Right.
For an S corp, there's essentially, the tax code says there's an entity here of the business owner, and now the business owner can take a salary from the S corporation, and then income flows through to them in two ways. They're doing payroll. They're actually getting a W-2 from the business that they own. That's one segment of the income, and the balance gets paid out to them as a distribution. In the context of an S corporation, the profit sharing contribution is going to be 25% of the W-2 wage. It's not going to be 25% of the total income. It's going to be 25% of the W-2 wage.
Got it. And the benefit for that for a self-employed is if you're doing distributions, you don't have Social Security and other that you have to. I mean, it's just income, or is it? Maybe you could go into that real quick just to clarify.
And you can see here why there's a lot more analysis that really has to be done when choosing to be an S corporation.
Right.
You see why CPAs have their perspective and a retirement professional would have a different perspective. So when people think about taxes, they immediately think of income taxes. But there really is another tax, which is the payroll tax. Your FICA, FUTA, SUTA. That's a Social Security tax. When you've got and those add up to about 15.5%. There's a 15.5% payroll tax on earnings of up to $130,000. I'm just using round numbers to simplify things.
Right.
But these are very close approximations. So when you've got a W-2 from a company, so the employer pays about half, and about half of it comes out of the wage. Somebody's self-employed, then they're paying the full 15.5% self-employment tax. Well, self-employment tax is paid on self-employment income, or if you've got a salary in place, if you've got an S corporation in place, and you're paying yourself a salary, you only pay that 15.5% payroll tax on the portion that's a wage. So theoretically, if you're making $1 million and you set up an S corp, well, the biggest bite of the payroll tax is in that first $130,000. And anything above $130,000, it drops down to about 3.5%. But suppose if somebody has a business that's making $1 million, on the first $130K, they'd be paying 15.5% payroll tax. And on the $130K to $1 million, that segment of it, that 870, they'd be paying in 3.5% in payroll tax. Well, suppose they say, look, let's make an S corporation, and then I'll pay myself a salary of $10,000. Okay, so I'll take $10,000 as a salary and $990,000 of profit distribution, and I'll only have payroll tax on the $10,000 salary. I just saved myself a bundle.
Right. Well,
that's a strategy, a very, very best way of doing it, or downright reckless, perhaps.
Right. And if I understand, is there not some sort of requirement that you take a salary that's representative of the work you're doing? I mean, you can't just say, I'll take a $1 salary for the year and and the rest will all be I mean, distributions.
Yes, you got it. There's a requirement that you pay yourself a reasonable compensation. And reasonable compensation, and we can see in case law and audits how the IRS calculates that. So they're looking to say somebody's providing comparable service in your region, right? Because compensation rates vary. New York City, Los Angeles, and Boise are not the same. So what would you be getting paid providing this service objectively in your location? So there really is an analysis that should be done. Now, accountants are generally very aggressive with this and may not provide a real analysis, and you'll find people taking very, very low compensation. Under audit, there's no way it would be sustained, but the audits in this area have been very limited. There have been audits, and there's substantial penalties associated with that, but for the most part, taxpayers have gotten away with that.
Got it.
As regards to our numbers, though, what happens here is if somebody pays themselves, sets up an S corporation now, and they're paying themselves only $10,000 in compensation. Well, their 401k contribution limits is only going to be about $12,000 because it's going to be calculated based on their wage, their tax deductible amount based on the wage. And so it's really tricky here because now what happens is you may have saved yourself payroll tax, but you got income tax instead.
Right. You've kind of screwed yourself on getting the funding your 401k there. I mean, by limiting that, right? Gotcha. So, okay. So the framework basically is set here is if you are a self-employed individual, you're making money, you've got a retirement you'd like to fund. This is the framework that would give you the maximum flexibility, correct?
Yes, you get potentially, you can do $55,000 tax deductions, or you can do $55,000 of Roth, which is really powerful. Lots of people want to do Roth, and in the IRA space, either they're capped out because of their income, or because you can only do $5,500 of Roth. Inside of our 401k plans, you can do $55,000 of Roth money, which is tax-free forever. And I guess I suggest people reference the first episode that we did,
right,
to get the distinction between Roth and traditional. You can also take a loan. So we can have somebody take a $55,000 tax deduction and then pull out money right out back to themselves as a tax-free loan from the plan and use it for whatever they'd like. So they can keep the money in the plan and invest it tax-free, and we give our clients the ability to put it into real estate, hard money loans, whatever they want, more or less, just about anything. Very few limitations imposed by the tax code. But some folks want to, they may have some expenses or some investment that they want to fund outside of the plan, and they're short some cash. They can get in these 401k plans, you can take a loan of up to $50,000. It's non-taxable because it's a loan, and to be used for any purpose. Personal expenses, investment, business. There are rules. It's got to be paid back over a 5-year period with some interest, but even interest that's going right back to yourself, right back into your tax-deferred 401k plan.
That's interesting. So you could essentially on December 31 fund your solo 401k with a cap of 55 if you structured it right.
Mm-hmm.
Then January 1, January 2, or I mean, is there any seasoning of that money before you loan it back to yourself?
So there's no seasoning requirement. There are the way the loan limitations work. There are two factors. There's that $50,000 cap, and then there's another cap, which is it can't exceed 50% of your balance in the plan. So if you have $100K in the plan, you can borrow $25K. If you've got $100K in the plan, you can borrow the full 50. But you can never exceed 50. So even if you've got $1 million in there, it's still 50.
Okay, so any one loan can only be 50,000 or 50%.
Or it's more than that. So it's not as if you can do a loan the next day, do another one for 50. At any one point, you can never have more than 50 outstanding. And if you had a loan in the past year and you've paid it off, there is a bit of a calculation as to how much you can take out. So if you did a loan for 50, and then you paid it back immediately, there would be the amount you could actually borrow subsequently up until 12 months elapsed would be a little less.
Just want to make sure I'm on the understanding here. On the 50, we're talking $50,000 or 50%?
50,000. But
Gotcha.
there's 50% and 50,000. Those are the two caps.
Right. But the most it could ever be is 50,000, period.
That's exactly it.
Okay. Okay. We talked, or you hinted at earlier, the LLC inside the 401k. Should we get into that now?
Yeah,
or is there...
let's do it. It's good to outline what it is.
Yeah.
Because also sometimes there's confusion between the IRA LLC and 401k LLC, and whether or not 401k checkbook needs an LLC. It's good to outline the distinction.
Right. And I don't want to run past the Roth. We discussed it at some length last week, but just if you want to just kind of briefly summarize the benefits of the Roth for anybody listening.
Yes. So the Roth contrasts with what we call traditional or regular contributions. When people think of 401k IRA, many people immediately think of tax deductions. The true term that's should be used for a traditional IRA, a 401k contribution, is tax deferral. So you eliminate the tax at the time of the contribution. It's as if you didn't earn that money. It's not part of your taxable income. For the next couple of decades, it grows without paying any tax. You get earnings on that money, no tax on the earnings. You get all that compounding. But down the line, when you pull the money out of the IRA or 401k, it will be taxed. So it's tax deferred. It's kind of kicking the can down the road and having the incredible benefit of tax-free growth, which enables you to grow your retirement account and your money at an incredibly accelerated rate.
Right. What you're getting the benefit thereof is the full amount, but when you take it out, you'll be taxed at an ordinary tax income or ordinary income tax. Right. Correct.
That's exactly it. Well, our Roth, in contrast to that, that money is not removed from your income today. There's no tax deduction. If you make a Roth contribution in 2018, that income will show up on your 2018 tax return. It's regular income, no tax deduction. However, from there on in, it is tax-free forever. The earnings on that money will never, ever be taxed. And that's incredibly valuable in many, many scenarios. There are a lot of different moving pieces that you'd have to think of before you make a Roth and make that choice. The biggest thing that we see, I think we mentioned this last week, is if you think you may have what we call asymmetrical returns, an investment where the potential upside is just incredible. Thinking Peter Thiel and Max Levchin that have Yelp and PayPal stock inside of IRAs that are worth hundreds of millions of dollars. Well, up front, they didn't take a tax deduction. They put a few $1,000s in there. They bought that stock within their retirement account when it was fractions of pennies. And today that's worth hundreds of millions of dollars. They just saved themselves hundreds of millions of dollars in taxes by doing it in a Roth. Contrast that with Mitt Romney, who also reputedly has an IRA that's worth hundreds of millions of dollars. Really, the number that was bandied about back when he was a nominee, was a candidate, was $120 million. Well, he supposedly has that inside of a SEP IRA. SEP IRA has no Roth component. Well, he's going to pay tax on that one day. All that growth, yeah, he put in a couple $1,000s, and it grew to be 120 million. Well, 50% of that's going to the IRS one day.
Gotcha. Okay. So we've distinguished about or made the point about the traditional versus the Roth. Let's talk a little bit more about the LLC inside the 401k.
Yes. So when we set up these plans, you get what we call the checkbook control. You get the money in a bank account and you can buy real estate in the name of the plan. So the key thing is when you do that deal, you're not putting your own name on title as an individual. You're putting it, the plan is held, the real estate, the asset is held for the benefit of the plan with you as the trustee. Now, when you come to a closing, you come to a bank and you're like, okay, this is the who's signing, who's on title, and they may see something about 401k plan, which they're not used to seeing. That can cause a bit of friction. When people see something not familiar with, who needs that? So while it's definitely legal and doable and is done all day, every day by countless people, putting an LLC inside of the 401k streamlines the investing. This way, when you come to that closing, it's done in the name of the LLC. Nobody sees the 401k, knows that there's a 401k. It looks like business as usual. So it really streamlines the investing by inserting an LLC inside of the 401k, but it's completely optional. Some other benefits are, again, the asset protection, and that flows two ways. If you're buying multiple pieces of real estate and you want to segregate the liability that's associated with those properties, well, you want to hold it inside of an LLC. Just like you would if you invest in your own name, you have the benefit, the liability protection provided by an LLC. And then beyond that, this will vary by state, and this gets into greater asset protection discussion, which is probably beyond what we should do in this discussion. But a 401k liability in there, or a liability outside of a 401k, potentially those can spill over. Even though it's a 401k plan, there is the potential for liabilities to cross between the 401k account owner and the 401k. Inserting an LLC into the mix provides enhanced asset protection.
Okay, let me ask you this. Last week when we were talking about the IRA, we talked about the leveraged property and how the requirements were that it could not be a recourse loan. Same hold true with the 401k buying property?
Yes, and I'm so glad you brought this up because this is actually one of the incredible features of the 401k. When doing a loan inside of the IRA, there are two things that you've got to be aware of. One is the fact that the IRA owner can't personally guarantee it because they're not allowed to extend credit and transact with their IRA. So it's non-recourse, so you shouldn't violate their prohibited transaction rules. The other thing that we discussed at length is UDFI, which is a tax that can be encountered when an IRA invests in real estate using leverage. So if and to do a quick recap, you got $200,000 in the IRA, you want to buy a $400,000 property, well, your IRA can borrow the other $200,000. And now thinking of it this way, you've got 50% equity in the property, and there's 50% loan, that's debt. Well, and then you've got net income of that property of $10,000. Well, $5,000 of that is going to be taxable as unrelated debt financed income, which is okay because, hey, it's $200,000 that you don't have anyway. So you got the benefit of the leverage, a portion is going to be taxable.
Right.
Not to deter anybody, but as we said, no tax is better than some tax. And the 401k does not have that tax. There's a carve out for 401ks that invest in real estate that there's no UDFI on real estate acquisition indebtedness. So the 401k can borrow that money and not encounter this tax. So that's another really, really powerful feature of the Checkbook 401k.
Okay. What about the recourse loan?
Yeah, so that's the same. Okay. It's got to be non-recourse to the plan owner and participant.
Got it. Okay, so you get signed up. You guys can, essentially give the checkbook control. And from there, basically between the tax strategy, the growing of the account, the use of the money, whether you want to loan it to yourself or invest in real estate, or we didn't talk about loaning, doing private loans like we did with the IRA. Or can you touch on that real quick?
Yes, it's really, there's just so much that you can do. There are an incredible array of investments that can be pursued. The most popular ones are real estate based. So there's buying directly, taking an equity position in real estate, and there's also real estate debt. Be the private lender, be the hard money lender, and keep it passive, keep it simple, and you just collect those interest payments, and you can do that inside of the 401k. But we've got people doing cryptocurrency, we've got people doing really, really novel things that they've got access to, and with our plans, they can pursue tax shelter.
Got it. Just real quick, on the loan to others, is there any limitation on the amount like there is on the personal loan?
Right. So there's none whatsoever. And it's to provide the context and the concepts that are at play. When you loan somebody else money using your IRA or 401k, that's an investment. There are no limitations on investments. But when you loan money to yourself, right, in an IRA, you can't do that at all. That would be a prohibited transaction. Because as we discussed, you and your IRA can't be counterparties to a transaction. Even if you're ready to pay your IRA 15% interest on that loan, you're not allowed to borrow money from your IRA. You can lend it to just about anybody else other than your parents, children, and a few other related parties. But you as a disqualified person can't borrow money from your IRA. In a 401k, the same prohibited transaction rules are at play. So technically, having your 401k lend you $50,000 should have been a prohibited transaction. It should violate those rules that don't allow you and your 401k to transact with each other. Except that Congress came in and provided an exemption and said, it's like a carve out. All right, your 401k can lend you money up to $50,000 and it's not going to be a prohibited transaction. So being that it's a carve out, it has limitations. But when you're lending to an unrelated party, there are no limitations whatsoever. That's a great investment. If you would lend them $100,000 as an investment, well, do it. Got it.
Bernard, just looking on the clock here, and we have covered a lot of ground. Is there any one thing that you'd like the listeners to come away with from this conversation?
The one thing that I emphasize repeatedly is that there's a wealth of financial, tax, and investment strategies that are out there. And anything that you do in your financial life, you need an integrated approach and an educated approach. And the way the financial industry is structured is such that it's very fragmented and fractured. So you'll have the tax professional having his perspective, financial advisor having his perspective, and certain perspectives don't even get a seat at the table because there's nobody that's incentivized to represent those. It's your role to get educated and learn about all the various components and figure out how they best integrate, because nobody's going to do that for you. So you've got to be an educated financial consumer, learn about all the options and see what's best for your scenario. Of course, leverage what your CPA has to offer in his knowledge, leverage the knowledge of financial advisor, but you've got to bring it together and see what's best for you and know that you're the one that's best incentivized to make the optimal choices for yourself.
Words of wisdom. I like it. Bernard, where can the listeners go if they'd like to learn more and connect with you?
Best place to start is our website, 401kcheckbook.com. That's 401kcheckbook.com. And I welcome direct emails, bernard@resurefinancial.com. You can send me any questions. I'd love to connect with the listeners and respond to questions that they have.
All right. Well, Bernard, I've enjoyed this tremendously. I want to say thank you again for taking the time to do this. I've learned a lot, and I'm sure the listeners have as well. And look forward to doing it again soon.
Darren, great to be on your show. I hope everybody enjoys, all the value and information we've shared. And I likewise look forward to being on it again.
All right. For our listeners, if you liked this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.